You've heard it thrown around all the time, right? The PE ratio. Financial experts say it like we should all just know exactly what it means. But what is it really? Well, in the next few minutes, we're going to completely demystify this thing so you can actually use it with confidence.
First things first, let me ask you a simple question. Imagine there's a little business, and it reliably hands you $1 in profit every single year. What's that worth to you? Would you pay $10 for it? 20? 100? Now, this isn't some trick question. It's the fundamental problem every single investor has to solve.
So, how do they solve it? Well, investors have a go-to tool for this exact situation. It's called the PE ratio, and it's designed to give a quick, simple answer to that big question. How much are you paying for a company's profits?
Okay, so let's decode this thing. We're going to break the ratio down piece by piece and see exactly how it works. It's simpler than you think. The PE ratio, it just stands for the price-to-earnings ratio. And really, at its heart, it's just a simple comparison. It takes the price of a company's stock and it holds it right up against the profits or the earnings that the company is making. Let's look at the two parts, P and E. P is easy. That's the price. It's what it costs you to buy one single share. Now, E stands for earnings, but more specifically, it's earnings per share. That might sound a little complicated, but I promise it's not. You just take the company's total profit for the year and divide it by all the shares out there. Boom. That tells you the slice of profit that belongs to each individual share. And that's such an important thing to remember. A share isn't just a number blinking on a screen. When you buy a stock, you are literally buying a tiny piece of that company. You're an owner with a claim on its future profits. Now, to make this crystal clear, let's forget the stock market for just a second. Let's head down to Main Street, where we've got two different ice cream shops for sale. So here's where it gets interesting. Both Shop A and Shop B, they make the exact same amount of money, $10 a year in profit. But look at their prices. Shop A costs $100 to buy, while Shop B costs double that, $200. And that big difference in price is what gives them very, very different PE ratios. So this is the crucial part. What does a PE of 10 actually mean? Well, for Shop A, it means you're paying $10 for every single dollar of its annual profit. You can also think of it like this. You're paying a price that is 10 times what it earns in a year. So does that mean Shop A is the better deal? Is a lower PE always better? Well, not so fast. You see, the number itself, it's just the beginning of the story. It's definitely not the end. You know, this quote from Data-Driven Investor just hits the nail on the head. The PE is the first metric everybody checks, but it is so easy to misinterpret what it's actually trying to tell you.
Think about it. A low PE might signal a fantastic bargain, right? A hidden gem the market totally missed. Or it could be a huge red flag that the business is in serious trouble. And on the flip side, a high PE could mean investors are expecting explosive growth. Or it could just be an overhyped, totally overpriced stock. So how in the world do you tell the difference? Here's a great way to think about it. A PE ratio is like a stock's financial Tinder profile. It gives you a quick first impression, a snapshot. But you wouldn't make a huge life commitment based on one photo and a short bio, would you? Of course not. You need more context. And that brings us to the single most important part of this entire explainer. Context is everything. A PE ratio, all by itself, in a vacuum, is almost meaningless. It's all relative. First, you have to consider the company's life stage. Is it a young, fast-growing company, like a rocket ship? Investors are willing to pay a really high price today, a high PE, because they're betting its profits are about to skyrocket tomorrow. Then you have the large, mature companies. They're more like a stalwart oak tree, super stable, super reliable. But their fastest growth days are probably over. For these guys, a lower PE is way more typical. Second, and this is a big one, you just can't compare companies from totally different fields. It would be like comparing apples to spark plugs. It makes no sense. Every industry has different growth rates, different profit margins, and that means they all have very different average PE ratios. And this chart just proves the point perfectly. Just look at this. Auto manufacturers, their average PE is around 8. Now look at software companies. Their average is a whopping 35. This does not mean a car company is cheaper than a software company. No way. It just means investors have completely different expectations for how much each of those industries is going to grow in the future.
Okay, let's bring it all home. Here are the key things you need to remember so you can start using the PE ratio as a smart starting point for your own research.
All right, let's recap your new PE ratio toolkit. First up, the formula, price divided by earnings. It's how much you pay for $1 of profit. Second, remember that high or low isn't simply good or bad. It's all about what people expect for the future. Third, and this is crucial, always compare companies within the same industry. And finally, you have to know the context. Are you looking at a rocket ship or an oak tree? Use this as your starting point, your first question, never ever as your final answer.
Because if you rely on the PE ratio all by itself without digging any deeper, you could be in for a very wild ride. It's an amazing tool, but it's just one tool in a big toolbox, and you have to use it wisely. So we've established the PE ratio is the financial dating profile. It's where you start, not where you finish. The real question for you as an investor is this. Once you've seen that profile, how are you going to decide if you want a second date? Thanks for joining us for this explainer.